Hey everyone, and welcome back to the TruFinancials channel. Today we're going to be talking about car loans and specifically the 24 and 10 rule. So if you've never heard about that rule before, this video is hopefully going to give you some in-depth information on exactly what it is. Now, if by chance this is your first video here on the channel, my name is Dennis and we love talking about ways to make money, save it, and invest it to really help you build wealth. So make sure you hit that subscribe button down below and let's get right into this video. So the 24-10 rule for car loans pretty much goes as follows. Rule number one is of course the 20, and this is making sure that you put down at least 20% towards your car that you want to purchase. Whether this is new or pre-owned, you want to have at least 20% down. Now, of course, there's people that want to put more and there's others that would consider to put less down. But obviously, there's a good reason why this is a rule of thumb, because 20% down is going to give you equity in the car. Now, you might be thinking, well, why do I need equity in the car if I'm getting the loan? Shouldn't I be good because I can just sell the car if need be? Well, let's say you go ahead and you bought a car for $36,000, right? And you put nothing down on the car. And all of a sudden, within the next couple of months, something happens and you have to sell the car for whatever reason. You can't afford it anymore. Maybe you lost your job, whatever the case may be. All of a sudden, when you try to sell your car, it's most likely already at that point probably 10% less than it was originally worth. So it's worth maybe $32,400. And if you put 0% down, you have to make up that difference if you want to sell the car. Otherwise, you can't sell that car without being able to pay that difference. Now, you can possibly get a loan for the difference, but again, you're going to be stuck with that. Now, potentially, sure, you can maybe sell that car for 34, maybe 35 if you're super lucky. But the amount that your loan has gone down typically is not going to reach where the value has dropped in the couple of months since you've owned the vehicle. I mean, 10% is usually just in the couple of weeks after owning the car. Cars go down in value fairly quickly, so that's why having this good 20% down is going to help save you and protect you in case anything happens. Now, if you're lucky and you don't have any problems, then you just had a good head start when it comes to building the equity between what you owe on the car and what the value of the car is. Because the last thing you want to do when it comes to something that goes down in value is to be underwater in it. And if you've never heard of underwater, what that pretty much means is that you actually owe more on the vehicle than what it is actually worth. So let's say you have that $36,000 car that you bought brand new. A couple months later, it's worth $32,400. By a couple of payments, you're probably still having to owe $35,600 on the loan, which means, again, if you wanted to sell the car, you would have to make up that difference. And that's essentially what being underwater is, and you don't ever want to be in that position, especially with something going down in value. Now, one thing I really want to stress out when it comes to wanting to put money down on a car, you might have dealerships and the people working there try to convince you to not put more down. For whatever reason, they're going to try to convince you that putting more down isn't going to change the payments that much more. And to be truthful, it probably will be true. Putting an extra $1,000 or $2,000 won't change a big amount on your monthly payments. But what it will do is it will give you that equity difference. So in case of something happening, you can sell the car and not have to worry about it. Now, here's the biggest thing when it comes to putting bigger amounts down and actually only having a small impact on your actual loan is for the next step. And this is to actually have the rule of 4. And the rule of 4 is making sure that you don't finance a vehicle more than 4 years. Now, there's a couple different reasons why this is so important and very vital when it comes to being an owner of a vehicle. Vehicles, like we talked about, go down in value, right? But also, too, they have a lot of maintenance issues over time. If you have a car loan for 6 to 7 years, which cars are getting to nowadays, that just means that you're going to be, of course, paying more on interest. So the longer your term loan, the more expensive it's going to be when it comes to paying interest. But here's where they get you a lot of times when it comes to car dealerships, is when you are paying more interest, your monthly payments are typically going to be much, much lower, which really entices you to go with that option. So why would you want to pay $500 for 4 years and then say $400 for 6 years? I mean, that just sounds like a better deal on paper. But on the back end, on the things that they really don't show you, is that you're going to be paying quite a bit more. Now, here's one example of how much you're going to be paying. And of course, this is just strictly an example. So let's say you decided to put the 20% down on that $36,000 car. Good for you. Like, that is what you want to do, right? Put the 20% down. So if you have an interest rate of, let's say, 4% for 4 years, you're going to pay a total of $2,413 in interest. Now, if you got that same interest for 6 years, which typically the longer the years, you might actually end up paying more in interest, but this is just an example. You'll actually end up paying $3,642 in that time period. And the difference of that is $1,229. And again, yes, the actual monthly payments might be lower for the 6 years than it is for the 4 years, but the amount of interest you're paying is going to be pretty significant. I don't know about you, but $600 every single year extra in my pocket because I'm willing to be able to pay more on a monthly basis to save more on interest is the way to go. I could use $600 for a lot of other things, investing or saving, whatever the case may be. So one thing I have a lot of people tell me when I kind of go over these examples with them is that they're gonna tell me, hey Dennis, well, it is going to be a lot more expensive to have a 4-year loan versus a 6-year loan. So this is what I tell them. I'm like, if you can't afford 4 years on a vehicle, it might be too much of a vehicle for you at that time. Even if you put the 20% down and that 4 years is going to be a really high percentage of your overall income and what you're bringing in, then that's not going to be a good option for you. You don't want to go to the 6 years because all you're doing is paying more in the long run and you're still essentially going to have those expenses. It's just spread out more. And why would you want that for a vehicle that's going to go down in value, that's going to need maintenance as well, which is actually going to be rule number 3, and this is the 10 rule. And this is making sure that you keep your total transportation cost at 10%. So if you're saying that you can't afford the 4 years, but you can do the 6, all that means is that you're gonna have more potential issues that are coming around for you to have to expense out. So if your budget doesn't allow you to do 4 years, that car, again, just might not be the right car for you. So that just means either bigger down payments, that means maybe just putting aside and getting with a used vehicle for something that you can actually afford. Now, for anybody that's curious on this 10%, this does include the car monthly payments, the insurance, the gas, and also even the maintenance on the car. Of course, there's good rules of thumb on how much you should put aside every month for car maintenance because that does come up, whether it's for the regular oil change, tire replacements, or even actual big expenses that come with owning a vehicle. You know, you should be putting money aside ahead of time, but if you're taking up more than 10% of your take-home pay, all that's really going to do for you is you are putting money into something that, again, is going down in value, as I keep emphasizing in this episode. So if your transportation budget is well over 10% when it comes to the car payments, the gas, the insurance, and all that stuff, that just means you're going to have less room in your budgets to be able to use for investing, for saving, for other big important financial decisions that come up in your life. So really evaluate the importance of the transportation that you're using in accordance to everything else that you want to do financially. So a quick example here is that let's say your take-home pay is $4,000 a month. Your cost for transportation should be no more than $400. So you got to be very cautious with how much you're spending, how much you're putting towards these things, because again, this is just one aspect of your overall budget. And if it's a large portion of it, it might hurt you in the long run for financial growth and wealth building. So I know some people are going to be mad, maybe dislike this video, and maybe even put in the comments like, Dennis, you know, you shouldn't be mentioning all this when it comes to cars. Like, people should have the cars that they deserve, whatever the case may be. And so be it, that might be true, but you are putting way too much of your net worth into something that's going down in value over time. So I don't know why people keep doing this to themselves, where they put so much of their net worth in a car versus a house versus investments versus anything else that goes up in value. They just put so much of their net worth in a car. So this is why it's so important to follow this 24-10 rule, because of the fact that you're putting so much value into a vehicle versus anything else in your financial world. It's going to really hurt you if something were to happen to you, whether it's a rainy day, whether it's the overall economy. It's going to hurt you in the long run, and you don't want to be in a position that you can't be successful in your finances because of a car, because of something that gets you from point A to B, which a ton of vehicles out there can do with a relatively cheap cost, but we just have to have the latest and the greatest. So don't put too much of your net worth in something that goes down in value. Okay, so after all that yelling about making sure you don't put too much of your net worth into vehicles, I do have some tips for you. So these are gonna be some tips that can really help you out if you're wanting to go buy a new or even maybe used car, so that way you don't get pretty much swindled into paying too much. So the first thing you want to do is make sure that you get pre-approved for financing either at a local bank or even online. This can go a really long way, so that way you don't have to go through the dealership's bank, so that way maybe you can get potentially better deals and a better rate. Now, if you want an online company, I do have Linkstream down below. That's a great company to be able to check different rates if you have a good to excellent credit score, so you can check them out down below. But other than that, there's a lot of companies out there that can really go a long way for you to kind of help make sure that you're getting a good deal and not just going with the dealership's bank. Now, the next tip is if you buy a used car instead of a new car, if you go 1 to 2 years older, you can save a lot of money. And I know there's people out there that will always kind of go against the idea of buying used, but honestly, I personally like buying used. I think it's a great way to go, and I save a ton of money. Another tip, and this one might seem basic, but I think a lot of people need to understand this, is if you buy a car that can actually hold some of its value pretty well. Now, Honda and Toyota are great companies for this, and there's a couple other ones out there, but there's some companies out there where their car values tank pretty significantly. So pay attention to what the values are. Kelley Blue Book is a great source out there for you to find out the value, to maybe check the rates on how people are loving the cars. So if you do buy a new or used car, you can make sure that it's going to last you a long time, not only in quality, but then also price as far as everything else in comparison, because of course they're still going to go down, but maybe just not as much. All right, so this next tip is going to be a pretty big one, and this is making sure that you do comparison shopping. There is no way that you can get the best deal if you just go to the first dealership and buy the car. You got to do online comparisons. You got to go to multiple different dealerships to make sure that you are getting the best of the best deal. Whether you are buying new or you are buying pre-owned, whatever the case, do some comparisons. Do some comparisons on the financing as well. Don't just go with one company or the dealership's, bank, because you're not going to get the best deal. You have to do comparisons. And this is not like grocery stores where you're comparing one grocery store to the next and maybe saving a few bucks here and there. This could be hundreds of dollars, if not maybe even thousands of dollars in savings because you compared different companies. I promise you it's gonna go a long way, and you should definitely make sure you do your research. And if you want to see more content when it comes to buying new versus pre-owned, when it comes to cars going down in value that are brand new, I want you to click on my videos right over here that are going to go even more in depth in these areas. Thank you guys so much for watching, and I'll see you in the next episode.